Hello, I'm John Mendelson. I'm CEO of the Asher Group, and I'm looking forward to sharing with you today the role of the life settlement broker. Before we do that, I'd like to take a step back and really talk about the purpose of life insurance as we know it already. Life insurance provides certainty that the family needs at exactly the most emotionally low moment that they need it most. It gives them the ability to know that their financial and healthcare needs are being taken care of, so now they can focus on their family. And that's really why people buy life insurance, because it does provide certainty down the road that they know they're eventually going to need. The life settlement market does the exact same thing, except while the insured is living. So the policy was put in place for a specific reason, and now when that policy no longer serves that purpose at the level that it did, they have an option. And instead of just continuing to pay the premiums or surrendering the policy for minimal cash value, they could appraise and monetize the policy. At that point, they now have that same certainty today while they're living. They can then work with their advisor to make good decisions for them and their overall estate plan. As we start looking at the role of the broker, it's important to talk about one thing, and it really comes down to representation. No different than any other business that you're in. If you were looking towards someone and you were doing a commercial real estate transaction, if you were working with someone else within another area, you would want to make sure that you're aligned with someone that's an advocate for you and a part of your team. So it's no different within the secondary market. The reason that a life settlement broker is important is they're 100% aligned with you through every regulation that they have, that they need to advocate on your behalf. They have a responsibility to you and your client, and that they're going to be there to understand really what's important to you throughout this transaction and how to appropriately manage the process, set expectations, and work with you to best deliver for your client. So what's a life settlement? For those of you that were not in here earlier, it's just a financial transaction that enables a policy owner to appraise and sell their life insurance in the secondary market. There's a number of solutions within that. But the way a broker should really take this process when we're educating you so you can use the right words and language with your client so this sounds legitimate, it dignifies the process, is, you know what, they have a lot of assets. So if they have assets, they typically know what they're worth. Well, life insurance is an asset. So how can you find out what that's worth today? You appraise it like you would anything else. So one of the main roles and responsibilities of a broker is to educate. It's to provide good information, so as you go meet with your clients, their children, the corporation, the attorney, CPA, whomever it is, you're showing them what this process is all about, and you're educating them. Some of the other presentations have been through this also. So how long has this been available? We've heard about Grigsby versus Russell and others, that it just essentially said that life insurance is an asset. And if you picked up a life insurance policy and you looked at it, the death benefit, is not really what's that important. It of course is important, but the most important part of that contract is the fact that it's assignable. And that was a big deal. So one of the biggest takeaways that we have from that first bullet is that there's a reason your client can donate that policy to a charity, to a cause that's very dear to their heart. They can reassign it. So that's very important. That court case talked about that. The UPIA, they really then classify that insurance is an asset, and it has to be managed that way. That's why we saw this cottage industry of policy audit firms that started coming out over the last few decades, and they're wired into the transaction. Well, if life insurance is an asset and trustees, fiduciaries, and others are required to treat it that way, what does that mean to you? What does that mean to your clients? What would the impact to them be if they weren't told that this was an asset or a piece of property? We see it every day. We see it in the lapse rates. We've heard the numbers. The report came out, 180 billion or some astronomical number. How many of your clients have come to you and told you, gosh, my insurance policy I hear is an asset. Is there a way we could appraise it or sell it? Most of them probably haven't done that. It's not a very well-known type of solution. NCOIL, Life Settlement Model Act, that's just one. There's been a lot, but sometimes people will say, well, gosh, your industry is just unregulated. And the answer is it's not unregulated. 5 to 7 years ago, there was a lot of nonsense that took place. So our role as a life settlement broker is to educate you and let you understand really what happens, whether it's your individual state or if it's your client that lives in North Carolina. How does that change? Is there any difference? And the answer is yes, we have different packets. So as a broker, one of the value propositions that you have as a broker is that we have individual forms with all appropriate state approvals, disclosures, recognitions that have to get completed. They have to be out there. Your clients, if they decide that they want to sell a policy in Nevada, yet they live in Arizona, but it's a trust owned in Nevada, we have all the appropriate state approved forms for Nevada. So you're essentially collaborating with a specialist that the broker should be able to provide that form to you. On the bottom code at the bottom, it will say what state it's been approved through. So it prevents you from having to go get into the administrative compliance world of getting a million forms completed. You know, we're going to talk a little bit about the difference between brokers and providers in a minute. However, if you wanted to really get the fair market value for a policy and competitive bidding, you would have to get multiple bids and go through that. So with a broker, you fill out one application to obtain multiple bids instead of providing, a series of, 3, 5, 10 different forms for all the different buyers, and you could, it could literally be, a couple hundred pages worth of inquiry packets. So it's a little bit cumbersome. And the last bullet is this case that we have here in California. We've spoken about it at the conference, the Larry Grill case. Whether this case goes forward or doesn't go forward, that it's not the key issue here. The key issue here is disclosure, and an agent and a carrier are now being alleged for some form of abuse, concealment, that they had heightened duties and responsibilities, and that they should have mentioned that the client could have sold their policy in the secondary market instead of reducing the face. I don't have a judgment on that. But what I do know is that when I look at where the world is today compared to 10 years ago, no one talked about transparency. I mean, I must hear the word transparency, once a week. It's like hearing the word organic today, compared to 10, goodness, oh no, if you don't say the word organic and anything dealing with food today compared to years ago, it's the same thing with transparency. So what are we doing? Well, that case right there is going to be pretty interesting, because what it's going to do is open the eyes of those that do have responsibilities, whether they're trustees, financial advisors, or other types of parties that influence the client. All right, just moving on. We're going to talk a little about avoiding misalignment in the process. And I know this can be a slightly touchy type of topic. A licensed broker versus a provider that represents the investor. Representation matters. And, I put a question mark next to fiduciary responsibility to whom. When we look at this, we have a very healthy relationship with providers and the different funds that they serve. But you need to understand they have 100% obligation to their fund. That's important to understand. They do a good job, and many of them are considered fiduciaries on behalf of their fund. And they're doing their job very well. Their goal is to buy a life insurance policy for an amount higher than the surrender value from the client at what they consider to be a fair price. And as you see there, fair value or fair price, not so sure that that's exactly what the client might be looking for many times. Many times the client is looking for fair market value. And fair market value comes up in the code over 700 times. When you see it, we do a lot of work with the trusted advisor market, attorneys, CPAs, bar associations, and on and on. And literally over 700 times it comes up. And when they talk about fair market value, it's exchanging hands from a willing buyer and a willing seller under no compulsion to buy or sell. Well, that is not fair value. And sometimes you'll hear about a very successful transaction that took place where someone went to maybe a provider that is doing the business 100% the right way. However, if that same client would have taken the policy to a broker, our obligation and our responsibility is 100% solely to you as the consumer and the advocate, the financial advisor, trusted advisor, and on and on. And in that situation, many times we end up getting offers that We negotiate a bidding process. We go through all the analytics. We underwrite internally, also externally. We do it all different ways. We have billions worth of comps as a broker. This is not just me speaking about Asher. I'm talking brokers in general. And we have a tremendous amount of data that we can then lean upon. And many times we'll look at it, and by the time we have our first offer to a last offer, it was 3 to 5 times, 10 times higher. So when you look at fair market value versus fair value, it's a very important time to stop. Take a deep breath and say, okay, I get it. If I was selling my home or a piece of commercial property, would I like to do that and facilitate it with one bidder? The answer is absolutely not. I want as many legitimate bidders as I can to put offers in there, and I want a party that truly represents my best interests sitting on my side. You would never have the buyer's attorneys represent you in the transaction. And effectively, providers, by every regulation they have, they sit on that side of the transaction. So if this room right here represented brokers or providers, right down the middle right here was the table. Everyone over here represents the provider and the investor. Everyone on this side represents the consumer. A broker sits on that side of the table. Dangers to be aware of are brokers that act like a provider, brokers that don't adequately shop the market, brokers that don't provide transparency to you. And we're going to talk about some of the types of questions that you can ask that any broker should be willing to answer if they're legitimate and if they're truly advocating on your behalf. Actually, before I do that, let me talk about the last point. Select one broker. Don't commoditize the policy. 2 is not better than 1. Now, there's many times there's confusion, and they'll say, well, gosh, Mr. Broker, what if I send it to you and then I also send it to this other organization, this other broker? The reason that can be very dangerous is no different than when a producer in the insurance planning world takes a policy and submits a policy to carriers. They all see a lot of the same information, and you're hoping that you have one story to tell. They're not seeing it being resubmitted by multiple parties. At the same point, each broker that you work with should have a certain level of expertise, and they should be able to explain that to you very clearly on how their process is and what it is. So you want someone to have one good story to tell as they negotiate on your behalf, so there's not conflicting information in the market that really causes the provider or the fund to say, you know what, this is too much trouble. I can't figure out who really has control here. Secondly, and this is the most important for 2014 compared to 10 years ago, we have licensed providers in every state. If someone says to you, you have to work with me, as a broker, I have exclusive capital. That was a 2004 to 2008 discussion. Today, we have regulated parties, firms like ours that do business the right way. We go through regulated providers on the opposite side of the table. We understand they're held to a higher standard. We understand that there's accountability in place. So if a broker today would tell you, come to us, we have exclusive capital, submit it to one firm but also submit it to us, that's not true. And if they do, they could be breaching some form of state law, and you don't want to be party to that anyway. So if you're going to do that. So we're all going to submit to the same 10, 20 plus different providers. The providers represent the funds. They each represent anywhere from 1 to 5 different capital sources on average. So you're going to get a tremendous amount of bidding competition. But most importantly, an experienced broker understands who has the most aggressive capital today. Someone that has a provider that has the most aggressive capital today may not have 6 months ago. A provider 6 months ago may not be aggressive today. So there's a danger in finding providers online that, frankly, they may not be the strongest in the market today. So we'll talk about some of those questions in a few slides. I certainly don't expect you to read everything on here. Yes?
If you go back to the other side, what you meant is any one policy.
Pardon me?
When you said select one broker, you meant for any one policy.
Correct.
Okay, thank you.
Okay, so moving forward, what we're illustrating here is what happens on a, this is just a micro level, but imagine, firms like ours and others are working on billions of policies on an annual basis. And we have a tremendous amount of data points, comps, and things such as that. So if you look at this, in this state, we have a death benefit of $4 million. Client could surrender the policy for $109,000 and change. The high offer was $1.55 million. Not too bad. Well, if you look at provider 1 through provider 12, because this went out to 12 separate providers that all had 1 to 5 different funds. So what does that mean? That means there's a tremendous amount of bidding exposure to licensed providers that know the business off one application. Look where some of these bids started. We have offers, we have declines. If you look at offer number 1, and the truth is this could have gone out to offer 15. I just couldn't make the slide too big, or I didn't want to make it too small. But it can be a very cumbersome process. But once again, as you select a competent life settlement broker, you're focused on your core business, serving your clients, doing what you do, and the licensed regulated broker is doing all of this while you're focusing on your core business. It's very important. And I'll pause for a second. There was a concern that firms like ours had 5 to 7 years ago, would we be disintermediated? What would happen? Producers were becoming more aggressive, more proactive. Well, what we learned is that everybody was trying to be everything to everyone 5 to 7 years ago. Come to us, we're a one-stop shop. It's the reverse today. Now people like to look someone in the eye and say, I'm really good at what I do, and I know what I do well, and I collaborate with other professionals that I feel are the best of breed in their business. And that is a safer way for them to not take on additional risk or liability that they possibly would have taken on years ago. So as you look at this offer matrix, you can see how sometimes the offers increase significantly, but if you look at the first offer compared to where they end, it is all over the spectrum. Certain groups that we work with, the best they could do, they weren't lowballing us. It's just the policy didn't fit well for their system. There's certain providers that are extremely aggressive on certain impairments, certain types of policies, different carrier ratings. They're all different. And a competent, legitimate broker should be able to provide a bidding transparency summary for you. I know groups like ours and others, we have a button we push. It's not that cumbersome. And then it could provide you a list of everything. Bids, counter bids, everyone should be able to do that. So these are things you need to think about as you're out there looking for potential partners to work with in the space. There's not a mystery here. It's not a mystery box. We're provided with gross offers that include everything from total fees to the amount to the client. All contingencies are provided. And if the broker hasn't provided contingencies, then you need to ask what they are, because every offer has them. So this does not have to be what happens behind the curtain unless you don't know the right questions to ask, and hopefully this is going to help you today. So as you see here, tremendous amount of work, many more offers, and you're able to leverage the one partner that you had as the broker. Are there any questions on this slide? Yes?
Does the $480,000 offer have the same terms as the $1,550,000 offer?
That's a good question. And I hate to let my inner attorney come out. The answer would be, it depends. Sometimes it does and sometimes it doesn't. They typically all have some form of Penn's final underwriting or final review. The important thing today, especially 2014 compared to years ago, is that origination matters. How that policy was put in place. The funds today and the buyers that are legitimate, they don't care if it was a 2 or 3 year life expectancy if it was not put in place properly. If there could have been any fraud, any issues, someone might have misrepresented something. No one wants to take on the additional risk. So sometimes it's the same, sometimes it's different. Someone should be able to provide you, the broker should be able to provide you what the contingencies are as you go through that. There's times where if you're looking at from a best execution perspective, the highest offer may not be the best offer. You might have an offer that came in and then turns out another provider that they're going to be a more efficient, effective close, and we'll recommend we go that direction. Absolutely, just like you said, just like a real estate deal. It's really important. This is a blend. This is something that what makes this industry a little bit different to understand is this is an institutional transaction. that meets an emotional, personal transaction, and they come together. And so you effectively need to have someone like and of course I'm advocating here talking about why a life settlement broker is important, but that understands that, and they can take the complicated and simplify it down to what's important. And so it's important to have that advocate throughout your process. Are there any other questions on this slide? Okay, we'll keep moving then.
I do have a question. So the difference between the final offer and the first offer is that you gave them more information? You just gave them more information that they got the final offer? I mean, why didn't they give you the final offer in the beginning?
Sure, and her question is, well, how come the final offer is essentially so much significantly higher from whether it's the one that won or those that didn't? And the answer is, they're no different than an individual purchasing a piece of real estate, whether it's a home or a commercial property, something. They'd rather not spend as much money if they don't have to. They're protecting their rate of return. They might have a little bit more sensitivity to the type of risk within the policy, the impairment risk, the way the policy is funded, and they're just not comfortable. But they want to let us know we're interested. So here's an offer. We're interested. Let's talk about it. We want to dig deeper to understand this. Another provider might come out, and there may not be a huge difference. They came out much stronger, and once again, they have one objective and one objective only, to as legally and ethically as they can, as a provider, purchase that policy at the best rate of return that they can for their fund, as they facilitate it with their fund. That's their goal is not to get the client $1.55 million. The provider 3 there would have loved to have purchased the policy at $480,000. Why? Because that's their job and their responsibility. They're not being malicious. They're not being manipulative. They are held accountable to their fund. It's our job as the broker to understand what that policy could be worth. And I'll talk about that in a little bit, the types of things that we do in 2014 that maybe didn't happen 10 years ago in this space, that it's material. We could sit there and show you the types of information, analytics that we run to make sure that we can defend whatever recommendations that we're making as a broker.
So as a broker, then you look at the first offer and you say, oh, we can do better?
Correct. So her question was, as a broker, when we receive that first offer, do we look at it and say we could do better? And the answer is yes. We'll look at it. We'll look at our analytics that we ran based off certain mortality assumptions, and we'll say, well, gosh, that's reasonable. It's very conservative. We believe, and we know where other competitive bids are coming in today based off different policy types, life expectancy projections, and a number of other factors. But once again, here's the good news. You get to focus on your client and your practice. You're not trying to figure out which providers are doing what rates of return they're purchasing at. Is this competitive? Is it not competitive? Gosh, this provider seems like a fantastic person. And guess what? They probably are. However, their responsibility is not to you. Their job is to purchase the policy and move this along because they're building a pool based off a certain amount of eligibility requirements. So we have a question in the back.
So if the negotiation process takes a while and premiums have to be paid quarterly and it starts to chip away at the cash value, or the client has to pay premiums, does that change the offer price? Can you work with that? Or
that can change. Once again, the purchasers are looking at the information we provide. The offer is only as good as the data that they're receiving and they're reviewing. But no different than someone that's selling their home. You have to pay your mortgage until you sell your home and you move out. You can't say, oh, fantastic. I just got the exact offer I need for my house. I think I'll stop paying my mortgage and we'll go to closing in a couple months. It seems comical. There were a few laughs here, but it seems comical. Well, that happens in our business. And they'll say, well, what do you mean I had to pay premiums? Well, the buyer projected that the account value would be similar to where it is now. And so once again, that falls into this gentleman's question earlier about contingencies. You have to understand where's the offer, what were the contingencies, and what does that mean? Another question?
Yes. Great answer, because you're right. When you do the first bid, I'm an investor. I represent someone trying to buy. you assume that there's going to be a premium that needs to be paid, and that's reflected in your purchase price. So to the extent the seller pays that premium, you can then afford to pay more. The seller also gets older over time, so as he gets aged, even though the price could go up because he pays a premium, the price could go because he's just a little bit older also. I assume in this one, provider 4, I assume you told provider 1 that provider 4 bid, I'm assuming you told provider 4 that provider 1 bid 1.1, and that's why he went to 1.25, because if he hadn't, if not for provider 4, provider 1 would have gotten it for the 1.1 million.
Correct, but
So you do tell the other providers what each one is bidding?
100%.
Okay.
100%.
I think that needs to be clear, because
I think
some people don't realize that.
I appreciate that.
You're telling other people what they're bidding, and that's what's causing them to bid up.
I appreciate you bringing that out. He's exactly right. So what we're doing is we're going to facilitate this transaction. We're going to tell provider 1, all the providers, where the bids are going, how they're increasing, what the contingencies are, what we're possibly able to negotiate out of a contingency. Well, we have a similar offer here, but they're not requiring A, B, C, and D, and that's less cumbersome or less burdensome on our client, or the advisor's client, excuse me. So, is that something that you're going to require no matter what? And they're saying, well, okay, we'll pull back on that. So we understand where all the different parts of the transaction that can cause pitfalls, potential speed bumps are along the way. We can't protect against everything, but an experienced broker will be able to help you minimize the types of headaches that you could potentially go through. Today, it's a much better, more efficient, and much more transparent process than it was years ago. So that's the great news for those of you that are here, or those that will be watching this at a future date. However, it is important to understand that this can be complex. So it's important to have an advocate throughout this whole bidding process. But the answer is it's fully transparent. Each time it goes up and the offer increases, we let everyone understand that. Sometimes they can't do it. They can't increase, and they say, I need another week or two. And depending on the time frames of the client, that may or may not work. Another question.
To understand the chart better, why, in my mind, why would bidder number 3 or provider number 3 and provider number 8 even continue to make additional offers if they already know that provider number 1 started off with 1.1?
It's a great question. Things change. Sometimes offers pen additional review of medical records. Sometimes offers, I don't want to say, are withdrawn or reallocated into other policies, but things happen. At the same point, we want to continue to collect as many offers as we can. We also think it's important to be able to illustrate as a broker, showing them what happened in the policy itself, and so they could understand from a transparency perspective what was available. And any good broker should be able to do that for you, because you're trusting and you're trusting this partner to do this. So when you're selecting a broker, it's important to understand, will they provide you everything that you really need so you can feel 100% confident through and through that you were fairly represented.
So, being on the buy side and talking with you and others who are running these policies, and sometimes we're told that the bids are some number by the broker, and how do we know that's really the truth?
So the question is, how do you trust where the bid is that the broker shared? And that's a really valid question. There's different ways to do it. One, pure reputation alone. Who do you know has the right business practices, the right transparency that they've had for many, many years? Who do you know in your instinct, and who won't? Do you know that does not provide that type of transparency? Question?
So many times we find out later it's not right. I'm not trying to pick on. I'm just throwing this out here. Because many times we find out that we've been misled about what the offers were, and so it causes you to wonder most every time if you're being told the correct thing.
And I think that goes to how you determine, and that's a wonderful other session that I would love to be a part of at some point, how you determine which brokers in the market do you feel are ones that you should be partnering with. If you're seeing repeated abuses or lack of clear information, then I think that's how you determine what type of origination partners you really want to have. We have 2 more questions. Oh, another question here.
Yeah, I'm not sure if it's a question
Sure.
or, I guess it is. There could have been a fair amount of activity with provider number 3 and 5 or 8 back and forth, up and down, before provider 1 even put in his first bid. So it's not necessarily because you accept more bids. This is not a timeline.
Correct.
It's not that you accept more bids in case something disappears, but it's
She's
a lot
100%
of daily
accurate.
activity.
Because those other bids might have come in faster than number 1.
Before number 1
Correct.
granted in the first place.
Exactly. You're right on. Yes.
I want to pile on to what you said. As a buyer, I think if a broker misleads us, that broker should be persona non grata, and therefore they wouldn't get bids from you, which would hurt them. The best way to keep these guys honest is when you find out that they're dishonest is to put them in what I call in the bullpen. And therefore, if you've got capital and they can't access your capital because you know that they're lying to you, that hurts them, and that's why people should not always have. That's why I said it's okay to use one broker on a policy, but if you only use one broker all the time, then that may not be in your best interest. You may want to use several brokers because some brokers get put in the bullpen because they don't necessarily behave on every policy the way they should. So I agree with you with what you said. You should, if a broker is not being what you like, if everybody doesn't do the business the way he does, then you shouldn't be doing business with them.
Any other questions before we move on?
I'm just making these numbers up because I can't remember what they were in this particular case, but they were similar to these numbers. So we recently had a case where we bid like $400,000 on a policy, and we were immediately told, "Well, no, it's $850. You got to hit $850, or you can't do it." Well, there was no way we could hit for $850, and in fact, we didn't believe there was any way anybody else could hit $850. No matter what information they had, and even if it was totally different than our information. So we rocked on and rocked on and rocked on, and then they came back to us and said they'd take our offer at $400. What does that cause one to think?
It could tell you that, and I'm going to talk about that in a few slides. What my first instinct would be is that there's 2 directions that could have gone. One, you're working with a broker you probably shouldn't have been working with right at that moment or in the future. They don't understand how to value a policy. They don't understand where the market's really at. 2, or the second one could be, frankly, you have a client who they know what where they'd sell it, period. And the analytics go out the door, and they still want to take it to market. And they say, well, are you saying you won't send it out to the licensed providers and tell them where we want to be? And our answer is, we're aligned with you. We're going to tell you it does not price at that level, but as your advocate or representative in this market, we will send it out. However, we still see the policy pricing in this range, and that typically is what happens. And the policy sells at the dollar amount that you just described. It doesn't mean that you can align from day one, but it's the job of a broker to make sure that you have a minimum reasonable range that the family or business understands that the policy should be valued at. We'll ask a couple more questions, and then we'll keep moving a little bit so we don't go through, we don't miss it, but we can start.
I can wait.
Okay. Okay.
If bids come in and there's a lot of extra tags on it, so you don't take the highest bid, how do you let the other side, let the client know, or how do they evaluate that? Do you just make it off the choose?
What you do is we illustrate it out. In today's world, we always want to be able to point to the email, the phone conversation, how we documented it within our system. So if we have bid A at $1 million, bid B at $980. However, this one requires, additional medical records, an additional life expectancy report, and, another type of requirement that is just a little cumbersome. And from timing, we're coming up on another premium being due. The doctors, sometimes can take an extra couple weeks to get medical records. Then the life expectancy, we joke around, it's this slot machine, and you just don't always know what's going to happen. And next thing you know, you have a life expectancy that comes out at a number that no one projected, that the whole transaction stops dead in its tracks. You don't want to get bad information out there either. So we really let them know it's their decision. We don't control the client. One of the biggest issues that we've always had, and a lot of brokers have had in this space, is that the provider or the investor can become frustrated, but we don't own and control the client. The advisor relationship and those that they trust, their family does. And the client themselves is the end decision maker. So we have to remember who we're serving. We serve an end consumer, and this is a very personal and emotional transaction. As I said earlier, that meets the institutional transaction. We have to be sensitive to this. This is not a trade. When I hear people talk about trades, I say they clearly don't remember who we're serving. We're serving somebody's parent or grandparent. Let's remember that. We're serving someone who has a significant impairment possibly. We need to remember that as an industry, and the broker obviously is aligned with that because that's who we serve, period. There's no way around it. Let's get one more question, and then I'm going to keep moving through it.
My last comment, I want to defend brokers again, because there's sometimes mischief with the providers. Some providers put a bid out there before they have the money, expecting that if they get the case, they can get the money, such as your 850. And then they discover that they can't find anybody to stand behind the bid. It would be nice if every provider, but I know for a fact that sometimes you say, okay, let them have it then, and you discover that they can't, it's not the broker's fault, that the provider can't come up with the money that's there. That used to happen. I don't know how relevant it is now. That used to happen a lot.
For brokers that work outside the LISA members, the licensed regulated entities, that can definitely happen. And that's why firms such as ours and others that are members of LISA, we work with the legitimate regulated entity, because that's exactly right. You want to make sure that the capital's there. If you set your client's expectation here, and now it's being removed, and now it's going to be down here, and right here is a perfect bid, then I can tell you it's going to be a difficult conversation. All right, we're going to move forward a little bit more, and then we'll continue to take questions in the spirit of the timetable here. So in here, we talk about due diligence, and sometimes people do as much due diligence on their dishwasher. They do more due diligence on buying a dishwasher than they do on the firm that that's representing them in the sale of their policy, whether it's a $100,000 policy or a $10 million policy. They find them on the internet. They find a little bit of information. They have a nifty, email that they received, and it's always amazing to us. So what we did for the next few slides, and these I'm sure can be made available to anyone. These are basic questions, and what I would ask you to think about is, as you review these slides, think to yourself, okay, why is that important to me? Why is that important to my client? So you would do this in any other part of your business. You wouldn't just go find an attorney online to draft your trust, an attorney online to facilitate the sale of your commercial property without actually interviewing them and understanding what are their qualifications. And LISA helps out a lot with that, because LISA members know who they are. There's a committee that reviews who these individuals are. So that'll help you from a checks and balances perspective, make your process a little easier and smoother. So this first one, business of settlements and secondary market solutions, is that no one can effectively operate as a sideline business. What does that mean? It's what I talked about earlier. You can't do this part-time. It's like someone trying to be, a part-time physician, a part-time engineer, a part-time this. Maybe if you did it for 25 years and you do project by project here, but to understand the complexities that fall within this transaction, whose capital is real, whose is not, understanding the closing process, and how to really manage the client's expectations, and the finesse part of the business, this is not something you do for fun. Because guess what? The consequences are tremendous to a senior or to your client. Maybe you're working with the 40 to 60-year-old, and you're trying to help them out with their 80-plus-year-old parent or 70-something-year-old parent. And now you've put them in a situation that is truly devastating. So you would never rely on someone that's not a specialist in a certain area. In other parts of your business, you shouldn't hear. We talked about taking the time to ask the right questions and managing the client's expectations. Anyone that's experienced on the broker side, as an advocate of yours, they know, they've been there, they've done that, and they should be able to tell you what to avoid, pitfalls to be aware of. We have this quote, and I'll just put it once: it takes 20 years to build a reputation and 5 minutes to ruin it. Think about it. It's Warren Buffett. And it essentially amazes us at times. People find somebody on the internet because they had a neat website. and they're sending confidential client data and talking about their health, their financial situation, when they truly don't know anything about the firm they just sent it to. Once again, you have Lisa. Lisa's a good organization that puts member firms through some form of a diligence, whether it's peer or background checks, things such as that. But as a professional and as an advisor, why would you want to work with a broker? Because you've worked for 10, 20, 30, 40 plus years to build your reputation. The last thing you need is to get involved with someone that does not advocate for you and harms one of your clients and the reputation you put together. So here's some questions to consider. Are they a member of Lisa? Do they only sell policies to institutional buyers, providers that are members of Lisa, not individual investors? Sometimes we'll have someone say, well, John, gosh, we found this offer you gave us seems tremendous. However, I know some guys in LA and New York and so that will put that together. And that's not something that we're going to get involved with. We're working with licensed providers. They're members of Lisa. They do business the right way. There's standards, there's accountability. In every state that they operate, they're accountable to the state insurance departments. They have more to lose if they do something inappropriate than if they just fly by the seat of their pants. So that's one thing I would say. Understand about the investors. You want to make sure your client has a good experience. Does the broker have any owner interest in a provider or a buyer? Who would think I'd have to put that on the screen? You need to put that on there because once again, you need to be aligned. Whoever's representing you, you want to make sure that they're 100% on your team. And that's a really important thing to understand. Does the broker or any of its principals buy policies for their own portfolio? We've seen things, one of the things that you'll learn about an experienced broker is each year has been like a dog year over the past decade. There's really nothing we haven't seen. And we understand what to look out for. And it's very difficult to sneak one past the goalie with an experienced broker that you partner with. Have any of the principals in their team been involved in any issues that they should disclose? Ask the question. These are important clients to you. They trust you. And the information that you're going to provide is personal. It's deeply personal, from financial to health information. These are not inappropriate questions. They may not answer them appropriately, but what we've learned for over a decade is that as an advisor, you have a bullseye on your back. If you don't do something right, there's someone that will let you know down the road. And if you can't take out the file and show what you documented within your system, that there could be danger, and there could be issues. Licensing, are they fully licensed or do they use borrowed licenses? Well, gosh, what does that mean? There's some brokers that just really work kind of part-time. They do have that website. They have some old relationships during the fabricated boom of settlements. We call it the dot-com boom in the mid-2000s. And people still call them, and they go out there, but they really don't know what they're doing. They're not working with HIPAA compliance and all types of things to make sure they're protecting your client information. So do they know what they're doing? Do they have a full-time compliance person that they can always put you on the phone with? So you can feel good about the process. Do they understand the legal implications? So these are things that you would do in any other area of your life. You're just going to apply the same logic and reasoning to this. Do they provide E&O? Any legitimate broker has E&O coverage that they carry for the oops situations. Things happen. Do I love it? Of course not. But are we required with certain national accounts, broker-dealers, carriers, others that we work with? Absolutely. And if they don't have that and they haven't taken it to the next level, then how serious are they about their business? Or are you going to be the one in the game of hot potato left holding, the last one? Do they provide bid transparency? We've talked about that. Do they disclose their commission formula up front in writing? Or do they play let's make a deal, in the process? Legitimate brokers will provide you, they'll rep and warrant in writing what fees are. They'll provide a breakdown. We do this. I know a lot of other groups that are legitimate do this. If they won't do that for you, there's a problem. They should rep and warrant in writing. We don't get gifts, spiffs, bonuses, trips, anything remotely that would not make us your advocate. Do they provide a bid transparency at the end if it's required? Or do they provide an offer, with the offer form, a full breakdown of what fees are and who's receiving what? A legitimate broker will do that for you. And if they won't do that for you, your instinct is probably right on. So those are things to think about. From a reputation and track record, how long have they been in business? That goes to any industry. Just in this business, it's important to remember, experience is the same as it is everywhere else. You want someone with a lot of it. You don't want to be the first time that they've come across something. So what types of due diligence have they been through? The top brokers within the industry have been approved by broker-dealers, insurance carriers, speaking at different associations and have been put through the ringer. They've made it through the test. So that's something that you should be asking. Tell me more about that. Who have you been approved by? What types of due diligence have you been through? Is there anything I need to know? Because I've worked for 25, 30, 40 years to protect my reputation and take care of my clients. These are good questions, and they're not inappropriate. These are things that we encourage you to ask. Will they provide all this in writing? I went through that again. Tell us a little bit about your team. If they're unavailable and you're getting voicemail or they're on the road, at a conference, who is there to support you? You deserve to have the support you need when your client calls. Do they have the right infrastructure in place to be able to service you? Or, are they really just building their business, or maybe not the right fit for an organization like yours or a reputation that you have? So an unsophisticated sales organization, that's me being politically correct, saying, are they just smile and dialers? Smile and dial folks, or do they have technical people that can answer the tough questions? What we've learned working in the high-end markets is that you need to have very smart people. Top brokers have a team that backs them up. So you have the promise makers and you have the promise keepers. Those in the back, those promise keepers, are the ones that will support you throughout this process. Are they a full-service brokerage? Do they do all these types of things, from underwriting, pricing, negotiating? Do they have a process for it, or do they fly by the seat? So is that something that they can discuss with you that you can feel comfortable with? These are all the types of things that why you would partner with a good broker to do this. Can you do all these things yourself that I've gone through? Is that something that you feel good about defending your process if you get the offer and you're back to that offer matrix and you sold the policy sold for $700,000, but it really, as we saw, the market value was 1.5. I think it was 1.55. How could you defend your process for what you're doing here? More due diligence questions. Do they do, well, actually, I'm going to skip through because we only have a few minutes left. How does your broker share information? So when you're selecting a broker, are they doing this in a secure manner? Are they HIPAA compliant? Ask the questions. You don't need someone types the wrong name in there and they just sent your client information, who could be a high-profile individual in your community, and they just sent it to the wrong source. And now that information's out there. So how do they do that? How do they share information? How do they allow you to send information to them? Do they have a secure upload so you can protect yourself or someone on your team from doing the same exact thing? These are all things that anyone running a legitimate business that you partner with should be able to provide as a minimum requirement. Do they use the proper forms? I talked about that earlier, and I know that seems a little petty. However, it is a time-consuming thing for you to go now get your forms completed in every single individual state insurance department. And if you want to facilitate competitive bidding, to do that with a number of different providers that do that, or you're going to have to get 3, 5, 10 different providers forms completed, which is a little bit cumbersome compared to just having one form completed. More due diligence. Do they follow, as we said, all applicable HIPAA and transparency requirements? Is it a predictable process that they go through, or did they seem as if every time you talk to them, they have a different story? This business might be a newer business or industry, but the broker that you work with should be able to walk you through a very predictable process. It should make sense. They should be able to have tools that can explain this for your client, to your team, so people feel good about the process itself. You should never feel in the dark. Because this is an industry that is not as well known, that doesn't give it an excuse either. There's appropriate tools, there's effective ways to communicate the value that you're trying to deliver to your client while obviously protecting yourself as a responsible advisor. We went back to this. I won't push too hard on it, but you work very hard throughout your career to build a name and a reputation. You've spent countless hours. We've all done the same thing, and one poor decision can really impact that. We've seen it in all different areas of business. So what we encourage you to do is really look for that advocate, look for the one that's on your team that specializes, no different than you would in any other business. Ask them the proper due diligence questions until you feel good about it. Someone that you feel understands who they really serve, and that's your client and yourself. So that's how we would really explain the role of a broker. It's really your advocate and your partner throughout this process. If there are any final questions?
So are there brokers out there that specialize in certain types of policies? Because I know there's some that buyers are looking for small policies or large policies, but do brokers, if you're doing all your own in-house analysis and underwriting review, does that matter?
I don't really believe there's brokers that only focus on small policies. Those that are doing in-house review, that's really to protect the time of the client, protect the time of the advisor, and of course their own team. That's the point. It's if they can't effectively tell you in week 1 or week 2 that this is not going to be a good fit, and they have to wait till month 2 or month 3, that's a problem. It means they're really not sure how to approach this market appropriately. Most of the larger brokers that are legitimate will work with policies that are as low as the 100,000 and then as high as tens of millions. The same producers seem to produce the same policies. So you can't effectively say we're not going to look at this $100,000 policy because the next one that they bring to you will then be a multi-million-dollar policy. Another question back here?
They might break it, a $5 million policy, they might break it into 5 $1 million policies if that's easier to sell it. I don't know if it's the advisor or the broker who recommends that, but I've seen it.
That could happen, and that comes within that first few weeks of discussing the case, the strategy, depending on the different factors within the case, the impairments, the carrier risk itself, and understanding the policy. You want someone who can obviously peel it back and explain to you really the best way to approach the market.
Thank you, John. You've done a good job with this, even though you've been asked some tough questions. I want to say a couple of things. Do you know of any legitimate people who are in our industry that aren't members of LISA? Just
some folks here that are now kicking the tires. No,
well,
I don't.
Besides that,
no, not really. If you're in the business, you need to be here. We're very deliberate. This is in effect, a large study group for those within the secondary market that are coming together to collaborate. We might meet you out in the market, next week. However, today, in the past few days, we're trying to get together, figure out more efficient ways for the market to grow, to scale, to work better together more efficiently, because until we learn how to do that and integrate it into the overall planning process where it becomes normal and people one day say, I can't believe there was a time when you didn't know you could value or appraise your policy.
So one last thing. You have to be careful, and you said this, of people who in the same conversation with you are sometimes financing entity, sometimes provider, sometimes broker. Because there are still, unfortunately, a few people who float around in our world that really don't know who they are and don't have any licenses. So you do have to be careful about that. There are very few, but there are a few. And unfortunately, the regulatory authorities don't have enough reason, evidently, to go after them. So most of the market and the people here are here. Most of them are legitimate, but there are still a few. And I just wanted to say that.
Any other questions? If not, thank you very much. Hope you found it helpful.